Ladies and gentlemen, good day or good evening, wherever you may be. Thank you for taking the time to be with us today. My name is Haigreve Khaitan, and I'm a partner in Khaitan's corporate M&A practice. I would like to extend a very warm welcome to this webinar to every one of you in our audience today. This is the sixth and the final webinar in our M&A series over the course of 2021. We've been thrilled with the tremendous response we've received to the M&A series, with literally thousands of people taking up to the invitation to register and attend, not only from India, but abroad as well. We are very grateful for the interest and support which our clients, associates, and others have shown in registering for this webinar. On this slide is the agenda for today's webinar. In short, the format will be a discussion between our expert panel, followed by a Q&A with audience questions. We've already received several audience questions, and if you have questions, please submit them in the facility provided in the webinar portal. If we cannot cover all of the questions in the webinar, we will answer them by email after the webinar. Please also note that a copy of the presentation and the recording of the webinar will be sent to you after the webinar. In this webinar, we will discuss how to structure earnouts in M&A transactions. Earnouts are an important device used in M&A transactions to deal with future uncertainty in the performance of the acquired business. Earnouts are of import to both parties to an M&A transaction. They're important to buyers because they mitigate the risk of uncertain business performance, and they're important to sellers because they provide an opportunity to maximize the sale consideration, a bit conditionally. In this way, earnouts are a potential bridge between buyers and sellers. Today, we will focus on the key considerations in structuring earnout arrangements, including commercial, tax, practical, and legal issues. Let me turn to our expert panel. Every person who has registered for this webinar has already received an email with full particulars of the credentials of our panel, and I will not spend time in repeating or summarizing their experience. Suffice to say, they are all M&A experts with excellent M&A credentials. We are very fortunate to have with us three leading M&A practitioners on our panel, namely Vivek Agarwal is the President, BFSI, HLS, and Corporate Development for Tech Mahindra. Sudarshan Ramakrishnan is the Managing Director in the Investment Banking Division of Goldman Sachs and a member of the Asia ex-Japan Mergers and Acquisition team. Sumit Seth is a partner and leader in capital markets and accounting advisory service and ESG reporting. Sumit leads PwC's capital markets and accounting advisory service practice in India. In addition, we are joined by my fellow corporate M&A partners, Prasenjit Chakravarti and Sharad Moudgal, who are both very experienced lawyers. So now let us begin our expert panel members. Bring it. So let me start with an introduction, and maybe I'll come to you, Sudarshan. What is an earnout, and how are they really used in M&A transaction?
Yeah, sure, no, absolutely. An earnout is effectively a contingent value payment that's made typically by a buyer of a company to a seller of a company. And it's a mechanism that we typically use to bridge, value gaps that exist typically in M&A deals. where the seller views that the future potential of the company could create a lot more value than the buyer is probably willing to pay today. And the buyer also recognizes the future value potential of the company. And so typically, it's some form of consideration that the buyer contractually binds itself to pay the seller based on future performance metrics of the business. And it could be in, we can talk about the consideration and how they typically are structured. But at a very simple level, it's a tool to bridge valuation gaps between sellers and buyers. And it's a commitment that a buyer makes to pay the seller based on future metrics.
That's really insightful. Thank you, Sudarshan. So if we dive deeper into this subject, Vivek, you've been doing M&A, I should say, by the day, and using earnouts in probably every M&A deal you do. So can you talk a little bit about some of the advantages and disadvantages of an earnout in an M&A transaction?
Thanks, Haigreve. As Sudarshan said, it's a great tool to bridge expectation gaps on valuation. And when I look at specifically our business, we do acquisitions. A lot of them are high growth businesses. One of the big reasons we use earnouts is to bridge the gap between valuation arising out of high growth scenarios. The second thing from our perspective, in a people business where intellectual property resides with the management team, with the founders, it's a way to keep them, retain them, keep them excited about the business and the growth. It helps us bridge gaps in management capability with the incoming founder team. And our attempt is typically to look at integrating them effectively into our management team going forward. I think just from a seller's perspective, firstly, no seller wants earnouts; they want all the money upfront. But that, if they are really looking to capture the full value of the future potential of the business, they do very reluctantly agree to those earnouts and performance metrics. So it is a relatively long and arduous process. When the business comes out for a sale, they do set up very large, aggressive business plans about how bright the future is. But when you start negotiating an earnout and putting a value associated with that performance, you go reasonably long cycles of negotiation on an earnout. So that's one item which I would call a disadvantage. That's a big disadvantage. And the second one is an earnout does make post-acquisition operations more complex. Irrespective of how you look at your integration strategy, whether you're doing a full integration or partial integration or standalone operations, trying to agree operating covenants and operating principles in the business for the future is very important. So that's a real big challenge, that when you have substantive value associated with the future performance, people talk about control, people talk about their rights, and at the same time, as buyers, once you invested significant capital into the business, the buyer also wants control of that business.
Well, that was fabulous. I think a masterclass on pros and cons on earnouts. So I'll move to another subject. In any structuring, tax considerations play a pivotal role, and structuring earnouts is no exception. In this short video presentation by our direct tax partner, Ritu Shaktawat, she talks about some of the key taxation issues one should be mindful of while structuring earnouts. Can we please play the video?
Taxation of earnouts in an M&A is complex, not just from a seller perspective who earns income and is therefore required to pay taxes on it, but also from a buyer perspective who makes payments. Now, from a seller perspective, there are mainly two tax issues. One is the nature of earnouts from a tax perspective. Is it additional capital gain income that the seller earns, or is it just employment-linked incentive, performance-linked incentive that the seller earns? And of course, taxability could change substantially depending on how earnouts are viewed from a tax perspective. And the second tax issue for the seller is, when is it taxable? Is it taxable upfront when the shares are sold by the seller, or is it taxable when the deferred payment based on earnouts is actually received by the seller? And on this particular issue, there have been contradictory rulings. As per one ruling, the payments are taxable upfront, and as per another ruling, the payments should be taxable in the year in which seller is actually receiving them, because court appreciated the fact that these payments could be conditional, and until those conditions are satisfied, seller cannot be considered as having earned that income. From a buyer perspective, again, there are two main issues. One is, how should buyer be treating these payments in its hands? Is it additional cost basis that the buyer gets in shares, or is it just a sunk cost for the buyer? And second issue is from a withholding tax perspective. If the share sale transaction is subject to withholding taxes, is the buyer required to withhold tax on the total consideration, upfront plus deferred, or just the upfront consideration? When we talk about applicable tax provisions, there is no specific tax provision dealing with these tax issues, and therefore there are these gray areas both for the seller as well as the buyer. And for buyer tax issues, there's no judicial precedent as on date which clarifies some of those aspects. Given these tax issues and concerns, it makes sense to look at structures which could help mitigate these issues to some extent, which could essentially help delink earnout-based payments from the upfront share sale. And some of the examples of such structures could be, let's say, where instead of selling all the shares upfront, seller sells the shares in tranches, and whatever is paid for a particular tranche is then taxable at the time when the tranche is sold, and not at the time of first upfront sale itself. From a buyer perspective as well, this structure should work better because it will have clarity for the buyer with respect to buyer's cost basis in shares. Whatever buyer pays for a particular tranche should be available to the buyer as cost basis in shares. The other structure could be where, let's say, a seller sells all the shares upfront but subscribes to a new instrument, let's say a redeemable preference share instrument in the company at nominal consideration, and then the deferred component is structured as part of the redemption premium on redemption of preference shares. So this also helps delink the earnout-based payments from the upfront share sale. Another structure could be, let's say, where the earnout based payments are clearly identified and recorded as employment linked incentive payable to the seller, when parties report this income as salary income linked to the employment exercised by the seller. Now, when these payments are offered to tax as salary income, of course the tax rate will be higher because employment income is taxable as ordinary income at higher rates compared to capital gains income. But still, this structure will have that clarity that seller won't have to go out of pocket and pay taxes without having earned that income. He'll be paying taxes only when there's clarity that seller is going to earn that income. Now, when we talk about structures of this nature, of course there could be other nuances each structure may have, even in terms of other tax issues. For example, taxation of redemption premium on preference shares is an issue in itself, and that needs a closer look and evaluation. Employment structure, whether it makes sense to structure it as consultancy instead of an employment model, is also something that could be looked at in detail. So while there could be these nuances and even the legal aspects would need attention, broadly structures like these could help mitigate the tax issue for the seller, where seller won't have to go out of pocket at the time of share sale upfront, where The subsequent payments may be uncertain, but he'll be paying taxes upfront without having the ability to recover those taxes later on. There are three important related structuring elements for an exercise of this nature. One is substance. Given that tax laws have anti-abuse regime now, it's important that whatever structure is finalized is able to pass muster under the general anti-abuse rules. The second will be documentation, again a very important element of the whole structuring exercise. Whatever structure is finalized needs to be adequately, properly documented in the transaction documents, because documents will be key in any defense proceedings before the tax authorities. And third will be valuations. Share deals are required to satisfy certain tax specific valuation requirements, and therefore those would also require attention. In closing, I would like to caution that there is no one-size-fits-all when it comes to structuring an M&A earn-out. What may work in one deal may not be appropriate in another, and therefore the optimum tax earn-out structure needs to be bespoke for the transaction. Every deal may have different commercial drivers, different requirements, different circumstances, and even the legal and other tax considerations may vary depending on those circumstances. Thank you for taking the time to listen to this presentation. I hope you found the discussion helpful.
I thought that's a great summary of the tax minefield in earn-outs. Let's move to another section, regulatory issues. Prasenjit, what are the regulatory issues that are relevant to structuring earn-outs, and how should they be dealt with, if you can share some light?
Right. Firstly, a very warm welcome to all the audience members, my fellow panelists, and thanks very much for setting the stage, especially to Ritu, I think, who has wonderfully set the context and stage for the structuring options, as she alluded to some of them in her brief video. There are regulatory concerns like any structuring we have. I think I will very quickly dissect it in three buckets. If you are dealing with listed companies, where we see lesser of earnouts, but there is SEBI norms which regulates incentive or upside sharing arrangements, and you need board and shareholder approval of people who are not interested. That's one bucket. Then we are talking about unlisted public companies. There is the SCRA, the Securities Contract Regulation Act, which needs the transaction to close on the date when the share is transferred to the next day. And therefore you really can't defer a purchase price in a public company situation. Oftentimes this is ignored. We see many people, parties miss that because people normally associate SCRA with listed companies, but unlisted public companies also governed by SCRA. Now let's turn our attention to private companies, where really the most of the earnout action happens, isn't it? Now, there the challenge is primarily when there is a non-resident shareholder, and the challenge stems from the fact that the foreign exchange norms require that as a non-resident you cannot hold back more than 25% of the purchase price, and for a duration of 18 months from the date of signing of the agreement. That really leaves a non-resident who is looking to structure an earnout, perhaps arguably not with enough adequate time to really for the earnout to play out. As we all know, perhaps from experience, earnout needs at least a couple of years to really do justice to the earnout construct. So the question is, what do you do about it when there's a non-resident buyer? How do you structure earnouts? There are 3-4 common options, I think, which we often explore. Firstly is really to defer the purchase price along with the acquisition of shares. So you acquire the share in tranches. So you acquire, let's say, 75% in one go, and the balance 25 in the second tranche when the earnout is payable. Of course, it has some issues because then you don't get a clean break as a seller. As a buyer, you don't get full control. You have to draft a shareholders agreement, which also has its own challenges. The second option is, of course, the employment model, where you really pay part of the earnout through the employment or consultancy fee model, or through a transitional services agreement model. That has some taxation ramifications, which Ritu was alluding to, which needs to be borne into mind. The other option, which Ritu also alluded to, is the issue of a non-voting security to the promoter, who is sought to be paid the earnout amount. Promoter subscribes to redeemable preference shares at a nominal amount, and if the earnout thresholds are met, milestones are met, the promoter will then be paid against the redemption of those RPS, the redeemable preference shares, at a premium. Again, of course, there will be taxation consequences which has to be borne into account. But the larger point is that the regulatory hurdle of foreign exchange law is not insurmountable. And like any structure we adopt, it has to be often a blend and amalgamation of 3-4 models and not one size fit all approach, because that never works in life. Even if you go to buy a car, not all car will have every feature, right? Oftentimes it's a mix of 2-3 options we have to go for. So same is with structuring, right? You have to be mindful of the options. Maybe part of the money you do through share within the foreign exchange law limits, part of it through employment model, part of it through escrows. I will give an example how we tackled one issue in a recent deal I did. So there, the parties did not want a tranche approach. They wanted everything to be closed on day one. So the entire shares have to be acquired. Employee model had some unwanted tax, ramifications. Capital gains has a better beneficial treatment under tax laws than an employee model, which is a higher tax incidence. So what we suggested is that the buyer paid the entire purchase price to the seller on day one, and the seller simultaneously put 40% of the purchase price in the Indian operated bank, which was the escrow agent. And that escrow agent was jointly operated by the buyer and the seller. And if the earnout was not met, the amounts would be released to the Indian company, the target company, which was operated by the buyer, controlled by the buyer. There's no question of foreign exchange outflow back out of the country. So the Reserve Bank doesn't come into the picture. And that was the model we adopted. Again, kind of out of the box thinking, because paying to the seller, simultaneous back-to-back arrangement with the buyer, same authorized dealer bank, got around that issue. Larger point is that, look, you will have to be very careful about accounting issues, which Sumit will touch upon, taxation issues, and what is permissible in the foreign exchange law, what kind of entity you're dealing with, public, private, listed. All these issues to be factored in holistically when you arrive at it. It's not insurmountable, but one must be alert and alive to all these issues. Hope this helps. Thank you.
Oh, thank you, Prasenjit. That was indeed very insightful. So let's move on in this journey of earnout. So we've discussed, what earnouts are. We've looked at pros and cons. We've looked at some of the tax issues. We've now looked at regulatory issues, and that really gets us to let's look at some of the structuring issues. So Sumit, if I turn to you, what are the key factors that should be considered in structuring an earnout in an M&A transaction? Could you share some thoughts? I think Sumit.
Can you hear me all right?
We can hear you now. Yes.
Yeah. Okay. Good afternoon, all, and thank you, Haigreve, for that. I think it's been a very interesting discussion already about tax, regulatory, business side. So, look, accounting, of course, an important area. Like my colleagues and others have already spoken about. Look, earnouts is really, if you say, sharing of risks. In a way, trying to bridge the meeting of minds between the buyers and sellers as to what they think should be the price, their understanding of volatility in the business, etc. So I would say a nice way to structure this is to keep it simple, and to do that, I would say two things. One is, if possible, keep the earnout period short. 18 months, 24 months. That way, elements of uncertainty, provide some comfort to both buyers and sellers. So I think that would be one suggestion. I think the second thing is to, define the matrix basis which the earnouts are paid comprehensively, and again, try and anticipate, different aspects of that. So, for example, in my experience, what I've seen and in others what I've looked at is earnouts are typically, based on either revenues, EBITDA, gross margin, or maybe a mix of it. For example, let's just take, revenues. Typically, it would be a multiple of revenue. And now there's a question as to what should be considered, whether it should be revenue as per GAAP, whether it should be billings, and this would be quite important, right, for technology platform, for example. And also with changes in GAAP and evolution definition of GAAP. The definition of revenue also has become more complex. In some companies would recognize certain transactions gross, others net. So again, I think it would be helpful to define the matrix very key. The other example which we see is the EBITDA. Typically, the earnouts would be a multiple of EBITDA. Now, the question really is, it sounds simple, but in the definition of EBITDA, what should be included and what should be excluded, is an important matter which could be defined. Again, in recent times, I've seen, for example, because of changes in accounting like leases, the EBITDA itself changed significantly, actually increased. So again, from that perspective, it would be helpful if the EBITDA could be defined more carefully and also consider, different aspects to it. Finally, an example could be where the businesses get merged in the larger entity. So in those situations, one would look at whether the company has the necessary processes, control systems to compile the carve-out information. So I think those are some of the factors I would say is to consider while defining the agreements and more clearly spelling out the matrix which are being kind of used. And last but not the least, many of the agreements will always have a clause that the final earnout payments is to be altered by a third party, so that again it kind of provides some assurance and credibility to the information. So those are my inputs or matters to consider as companies think about defining their earnout provisions in the agreements. Over to you, Haigreve.
Thank you, Sumit. Very useful tips indeed. I think your audio was a little bit disturbed, so maybe our audience lost a few of your points, but maybe on the email later we'll address some of these issues to the audience on the accounting and structuring side. Sharad, if I may then move to you, let's look at some of the benchmarks. And can you discuss typically what benchmark should be considered for calculating earnouts?
Sure, good afternoon, everyone. I think ultimately, like a couple of my panelists have already mentioned, earnouts are typically emanating from uncertainty in target valuation. So to that extent, what benchmarks you add really depends and flows from what the target's business is and the nature of the business that you're looking to acquire as a buyer. Now, again, in terms of private companies, this is a lot more difficult at times to kind of structure. And although less prevalent in listed companies, you do have a significant amount of comprehensive financial disclosure in the public eye. And so you have market prevalent pricing, etc. So earnouts are one, less prevalent, and two, easier to structure to that extent, regulatory aspects aside. So in the context of private companies, I think ultimately you would have to focus on outcomes rather than milestones. And it again depends on the nature of the business that you're buying. If it's structured to multiple group companies versus a single target, you get different complexities associated with this, especially in group company buyouts. And when you have cross-border angles to it, do you look at a certain sort of assets, sort of potential or earnings when you're structuring an earnout, or do you look at it on a group consolidated basis? Again, really depends on the contours of the deal as well as the business that you're acquiring. So boils down to, I think, the facts and circumstances that surround the nature of the deal as well as the business ultimately. Going to the sort of metrics that you would apply or the benchmarks that you would apply, I think ultimately what you're looking at is in the context of some kind of a business acquisition, you're looking at financial metrics to be applied. Now, this can be in the context of earnings or revenue, especially when you're looking at more mature businesses. But if you're looking at, say, emerging businesses or sort of nuanced sectors, the sort of benchmarks can vary. So I think something which is sort of typically traditional, like say a manufacturing business, etc., they're often profitable. You have sort of tangible value attributed to them. So it's normally a profitability-based benchmark or revenue-driven benchmark that you would sort of apply. Similarly, I think sort of key revenues from key customer contracts or sort of signing on to key customer contracts during a particular period in time are sort of applied to such businesses. But then if you look at tech M&A, for example, you're looking at sort of high growth companies, usually loss making, high revenues, not really profitable. So you would want to apply different sort of benchmarks when evaluating the acquisitions themselves. So I mean, I think let's say if it's say something which is content related, you're probably looking at a minimum user base or a consistent user base over a certain period in time to be applied in a tech company acquisition. Similarly, if it's e-commerce, it would probably be revenue driven or GMV driven, or generally the rate of reduction in losses. At the same time, you have nuanced sectors like life sciences. So I think any life sciences M&A, you might have, say, earn-out benchmarks linked to, say, drug trials. So it could be the extent of patient dosing in phase trials over a certain period in time, provided they start within a certain period of time. Similarly, regulatory approvals to certain new drugs or products that are looking to be launched, production milestones also within a particular period in time, sales milestones as well. So, I mean, I think in summary, you're really looking at the nature of the business that is kind of being acquired and the sort of precise milestones that would give you an accurate sort of presentation of what the sort of value would be in an otherwise sort of subjective aspect, because valuation is ultimately going to be pretty subjective in these aspects.
I mean, I'll just add, if I could add, I think the principle to arriving at this is primarily driven by value. So the way we advise our clients is based on how you would think about valuing the target, how you would choose to defer the value will be based on the same parameters, right? So if it's a company that you're valuing, that you think the value is based on its user base or its revenues or its earnings, use that philosophy to extend the value argument and structure the earnout. And, you know, multiples might change over time. The value that might get realized 5 years down the line might be very different. But at that point in time, that's the information the client has to structure the earnout.
Oh, that's very useful. Sudarshan, you would have seen in your transactions where earnout payments actually have been far more than what they were, anticipated, at the time of perhaps closing of the transaction.
Yeah, I mean, look, I'd say this. I'll say that I've seen everything. I've seen situations where earnouts have been higher, situations where earnouts have been lower as well. But in general, you'd say that especially in the emerging sectors, the ability to forecast what that business looks like 5 years down the line is really a judgment. I mean, most of the time, the projections that the acquirer, and Vivek should comment, but I'm sure there have been acquisitions he's made where, the visibility over 5-year forecast versus actually what plays out is very, very different. There's been a lot of evolution even in the IT services sector. And you tend to see value realizations that are higher. You tend to see those that are lower. And, both can get equally contentious based on the objectives of the buyer and the seller. So, yeah.
Yeah, no, absolutely, Sudarshan. And I think the way I think it works best is if there is a reasonable certainty of a range you're trying to hit in an earnout or valuation, a capped earnout works. But when the uncertainty or the opportunity is significantly high, and you can have a very high possible earnouts, the easier or probably the more simpler approach to do this is a staggered buyout, with buying a residual equity linked to the outperformance of the business.
Yeah, that's the structure I've seen more as well. I think to the point Prasenjit made, like we work with a lot of, I want to say, either international buyers who are looking at India, or we're working on the sell side where there are international buyers coming into India. And because of that limitation around deferred consideration, most of the time you see staggered buyouts where the equity gets purchased over time based on some sort of a pre-agreed formula.
Very useful thoughts. So moving to you, Vivek. So as a serial buyer, maybe you'll be best placed to answer a question like this. What rights with respect to the target's operations, during the earnout period, should a seller seek to protect its interests?
The post-transaction operations obviously is like, the wedding is done, the guests have left, the advisors, bankers, lawyers, everybody is out, and the buyer and seller are then left to deal with it and live with it on a reasonably long term in most of these cases. I think what's typically worked very well is the buyers and sellers not treating this only as a transaction, but getting an alignment on the vision for the business of what you're trying to achieve. It does need to get translated into the conditions and how you operate and the operating governance, etc. But getting a common vision, alignment, a lot of tough discussions around org structure, controls, rights, and they're best discussed upfront as early as possible in the process so that people are aligned. And then when it comes down to the actual paperwork, I guess it varies a little bit depending on what kind of integration approach you're looking at. Looking at buying a company and letting the existing management team and promoters run it as a kind of an arm's length transaction. I think it's more about the buyer looking for protections, in terms of, because they've put substantive capital behind it, so they're looking at certain controls around it. When businesses are more integrated with the parent entity, I think it's more a two-way street in terms of getting these terms. Largely from a seller perspective, this is about making sure that there is no leakage of value from the entity or the document, whichever is put. That's really the biggest item, and it boils down to how do you make investments, how do you take longer term decisions versus short term decision making. I think those are the areas which end up being debated a lot. But in practice, really, I think one of the things which works best, and we try and do it for our transactions, get to a very disciplined governance approach on a regular basis. You sit down with promoters or the residual shareholders and spend that time on making sure you're minimizing conflict and dispute, because most of the times there is always a way to work through a lot of stuff. And lastly, I mean, the most compelling argument you always see in this is there is a basic alignment of in value creation and value sharing here, because if you end up at 70-80% of the business and there is somebody owning the balance 20-30% economic value, one benefits, everybody benefits. That approach is obviously holds true. So having those continuous conversations and being transparent about it it helps a lot.
Haigreve, may I one quick interjection to supplement Vivek?
Yes, please.
Okay, thank you very much. So very useful points, Vivek, and I think just from a Indian law and how the contracts which are drafted will be interpreted by courts is that the courts will never intervene where sophisticated parties have negotiated a commercial contract, and therefore if parties are shy from negotiating contractual terms just because they don't want to upset each other and want to get a deal done and leave out terms on the assumption that, well, the courts will bail them out, that won't work. For example, the regular inspection right as a seller, after you have lost control over the company, if you're expecting the buyer to share periodical accounts, financial statements, unaudited statements, you better spell them out. If you want the buyer to invest a particular amount to on R&D, which is pivotal for development of a product, on which your earnout hinges. You spell it out. If you leave it vague on motherhood statements like good faith, all those are very difficult and tricky to kind of then interpret. And what is good faith, what is bad faith, then really is a very difficult task. But if you don't have anything, I mean, at least have good faith, because at least you expect the buyer to really not act difficult or whimsically, so that you are left stranded and have no help whatsoever once you have deserted from the company. So very critical. Courts will not intervene. Arbitrators don't have the authority. They will not, shall we say, fill in this gap created by inadequate drafting. Therefore, please be mindful to spell out as clearly as you can in the wordings in the contract. Thank you.
Oh, very practical and useful tips from both of you, Prasenjit and Vivek. Thank you. So let's keep moving, and let's look at now the process of determining earnouts. And Sudarshan, if I may turn to you, what is the process to determine and pay the earnouts in an M&A transaction?
Yeah, so this is, I'd say, a lot of time and effort goes into, I'd say, two stages when it comes to earnouts. One is in terms of drafting the earnout, right? And particularly in my experience, there's a lot of discussions when you're drafting the earnout around the definitions with regards the accounting terminologies that I use. So if you're using EBITDA particularly, EBITDA is notorious terminology which has a lot of adjustments attached to it. And so typically when you're going into the deal itself, I'd say expect a lot of time to be spent to bottom out the detailed definitions of the earnouts. And then I'll say then the governance around how the earnout gets realized is again a negotiation. Like, so this, you know, to the audience, this will not just be a smooth process where a number is determined and a payment is made and people tend to walk away. Typically you have, you know, each party, you know, either you decide that each party appoints some sort of an auditor or a valuer of some sort to determine the number which forms the basis of the earnout. And so if a buyer appoints someone, the seller appoints someone at the time of realization of the earnout, there is always this in between gray area that needs to be aligned. So, you know, the buyer comes up with a different EBITDA number, the seller will come up with a different EBITDA number as well. And so, you know, again, going to the point that Vivek made, in my mind, the relationship of the buyer and the seller in an earnout situations is probably paramount into ultimately realizing the value of the earnout. If that does not happen, typically you have a mechanism by which you can appoint a third, like a jointly appointed third valuer who will help you determine the earnout. That's something that I've seen, which is called it's called an expert determination. And, you know, again, it depends on how your contracts are drawn, but a lot of times you have these contracts where you would have a mechanism by which if one person realizes one number, the second person realizes another number, and the expert is somewhere in between, you will average out the expert to the closest number next to them, right? And so typically that's the mechanism that's put forth. Bottom line, in practice, what happens is if the relationship's good, these things are negotiated and realized. If things are tricky or the value at risk is tricky, then they get into the stage of, you know, dispute and arbitration, etc. So, yeah, I think that's kind of the mechanism and the process to realize the earnout.
Thank you, Sudarshan.
So, I may, if I may just add to what Sudarshan said, I think a couple of things. One is the smaller the number of variables you're trying to measure, the easier it is and simpler it is, just from a governance perspective. And I think the other one is, you know, there are a lot of people try and put carve-outs of what will go into a computation and it will not go into a computation. I think that's the other variation to avoid. And I've seen, and even in our case, we ultimately end up just putting the auditor's word as the final word to try and avoid this dispute and not ending up with a whole bunch of different ways of computing stuff. But that doesn't mean that doesn't arise.
Yeah, no, I think yeah, one quick supplementary point. I think both Sudarshan and Vivek talked about accountants and auditors. I think this kind of disconnects, logjams are fit for an accountant to resolve. These are not matter which an arbitrator can say, is the capex more than what it should have been? Is the bottom line met, or is the top line met? These are fit cases of somebody who's an accountant, and people often kind of gloss over when drafting this clause and refer to an arbitrator or court. They will just not be capable enough, in all due respect to them, to resolve these matters. So accountant should be the expert determination, the key player in that. His or her remit should be confined to what the areas of disputes are, and not the whole hog, and reopen matters which have been settled, which are not up for disputes. So that's a limited point I just wanted to make. Sorry, please go ahead.
No, thank you. No, so hold your thought on the accounting issues for a moment. Let's first get to some of the legal drafting issues, and how can one really make sure that the drafts itself and the provisions are clear. So, Sharad, over to you. What are some of the key legal issues involved in sort of drafting a earn-out provision in an agreement?
Sure. So, I think Sudarshan and Vivek covered largely what you would want to cover in an earn-out clause. And I think ultimately you are trying to lend some sort of clarity to the process, although what is key at the end of the day is commercial alignment between parties. So if you do not have that, I don't think, irrespective of what's in the contract, it isn't going to really matter much. Having said that, I think there are some key areas which you would want to cover as part of your sort of earn-out clause generally. And this can get technical and candidly a little drab as well when drafting as well as talking about it. So I'll be brief. I think the main thing is firstly looking at the earn-out period itself. Parties need to be aligned on what that is going to be. And I think it's in both parties' interest to sort of look at a shorter earn-out period. From a buyer's perspective, there's a higher administrative burden on the buyer in managing and tracking the earn-out over a particular period in time. Similarly, a seller doesn't want to be tied down to a higher degree of uncertainty over a certain period of time. So the idea would be to keep the period brief and during the period have certain bells and whistles for protection for both buyer as well as seller. And I think that's how you'd sort of start by going about this entire process. Similarly, during the period itself, there may be certain carve-outs that a seller might want where you want the earn-out to be accelerated. So, for example, there's a change in control. A seller would not want to be tied down to a new buyer who might not be as aligned as the original buyer to the earn-out construct itself. In such situations, sellers might just say that, look, let's agree to a pre-agreed value, which is going to be paid out to me in case there is an accelerated change in control during the earn-out period, so that I don't have to go through this process again with an unknown buyer who is not really my problem. I think, again, that's something that you want to call out specifically one way or the other, whether or not you have such carve-outs or not, so that it is clear from a documentation perspective and hopefully reduces the extent of disputes that you would go through in case there is sort of misalignment or disagreement at a later point in time. Similarly, I think, again, in both parties' interest to kind of prescribe ceilings of floors if it's potentially viable, so that you have a minimum and maximum amount of money that kind of can be paid to both parties, benefits buyer and seller as well. You would also have, during the interim period, during this earn-out period, protections for both parties. And this is usually more seller-focused, although buyer would want to resist as much as possible because the buyer would want as little control as possible during this period in time. You would have at least at minimum basic provisions and protections to say that parties will operate in good faith, buyer will operate in good faith, conduct business in the ordinary course, etc. At times, sellers would also want certain veto rights in respect to key strategic matters which might impact the earn-out benchmarks themselves. So say if it is inorganic M&A during the earn-out period, which is linked to a particular business, you would probably want to either have a veto over that. Buyers, of course, want to resist these kind of provisions in your clauses. I think the topic of EBITDA has been covered and what would be carve-outs, etc. So I'm not going to get into that too much. There are certain other sort of smaller nuances that you might want to kind of talk about in your provisions itself, say extending earnout benefits to management team. So I think it's in a sort of sellers as well as buyers' interest in a lot of situations to have the existing management team continue during the earnout period. So you might have provisions insisting that they cannot be fired without cause during this sort of period in time. And at times you might also incentivize them with incentive equity or some kind of phantom options, which are sort of again linked to the earnout period. Other sort of provisions that you would also see are the buyer wanting to kind of offset sort of indemnity payments against earnouts, etc., which sellers usually aggressively resist, but are nonetheless debated in a lot of situations. And I think finally, coming to sort of the key point on dispute resolution over here, and I think they've already covered it in large part, idea would be to have an expert sort of determine numbers in case there is a disagreement. And it's again in both parties' interest not to have, say, a panel of experts. Ideally, you should have a pre-agreed expert. Let's say it's another big four who either buyer and seller is not using, so that you don't have a disagreement as to who that expert needs to be at a later point in time. You cut through that entire process. And if all else fails, I suppose the nuclear option would be just dispute resolution through arbitration.
Okay, thank you, Sharad, for your useful thoughts. So I know we are getting to the end of the questions, and we'll be taking some questions as well. But before we get there, Sumit, can you talk briefly about some of the accounting issues one should consider?
Sure. Yeah, sure, I agree. So I think Sharad nicely has given you a segue into the accounting issues I wanted to discuss. And the first one is, compensation. So like many of us have already discussed, many of these earnouts, include payments to the selling shareholders, who then become key management employees of the acquired entity. And of course, that's important because one needs to retain the talent, who will contribute towards the business, have relationships, and of course, the experience. Now, typically what we see is in these earnout arrangements, if the selling shareholders who become the employee of the acquired entity, if they terminate or they leave employment, the earnout is forfeited, i.e. they are not paid. Now, in situations like these, clearly it has an important business reason. But once these earnouts are linked to employment or service, under all gaps, whether it's IFRS, US GAAP, Ind AS, these are accounted as compensation expense. So otherwise, something which would have been a cost of investment or then, a goodwill on the balance sheet, once these earnouts are linked to employee service, and if they are forfeitable, they become compensation. So that's a very big item, to consider. Of course, there may be good business reasons to do that. Like I said, but the accounting consequence is quite significant. I think the other area is always classification of these earnouts as to whether they are really liabilities or debt or equity. So let me take an example. When you have these earnout arrangements and, the acquirer has to either settle that by paying cash over a period of time based on the performance of the matrix which have been agreed, or decide to issue equity shares of its own. Now, typically, if these number of shares
I think we lost you, Sumit. We lost your voice.
Measurement of that. Yeah. Can you hear me all right, Haigreve?
Yes, we can hear you now again.
Yeah. Okay. So I think those are the two important issues from the perspective of the acquiring entity, which one would consider in the these earnout arrangements.
Thank you, Sumit. So we'll move to the audience questions, but I have one very short question before that for you, Prasenjit. Can you share that how has COVID impacted earnout clauses in M&A transactions very briefly, just because of what we are dealing with. It will be useful for the audience.
Yeah, no, I think obviously during COVID, the necessity of a risk mitigant tool, value mitigant tool like earnout has come to the forefront, even more. And increasingly more deals are witnessing this during the COVID times for the simple reason that parties are not able to be absolutely certain if the forecast which is laid out by the seller will be met or not because of COVID. Nobody expected such a devastating phase 2 of COVID, which really surpassed phase 1, and that severely crippled many businesses. Not only their performance, but how the market sentiments will go. Will the, let's say, consumer good have demands, or will the demands plummet? Will the customers pay on time? All of this needs to be tested. So I think because of that uncertainty, and it's still looming large, right? The phase 3 is still around the corner. I hope it doesn't hit us, but well, I mean, it seems inevitable. So if the target's fundamentals are good, I think both parties are mature enough and being advised by sophisticated advisors that instead of tanking the deal, let's do an earnout model and really. And one other thing we have noted, at least, is that the earnout periods have become more protracted, elongated. It's not a 1 year quick 18 months window, because that may not be good enough for riding over the tide of COVID-19, isn't it? So people are going for slightly more longer period, 24 months, 36 months, wait and watch. But of course, what they are doing in the process is making staggered payments. So it's not all or nothing or everything to be paid at the back end. They're releasing payments as certain milestones are hit, after 12 months, so that the seller is enthused and the earnout period doesn't seem like an eternity for the seller. So those are the two, I would say, changes I have seen during COVID times, the earnouts. The longer period of earnout, and the second is payments, periodic payments being made. But yes, definitely, I think the importance cannot be overstated in these times of uncertainty.
Well, thank you, Prasenjit. So let's move to some audience questions. I know we have limited time, but we'll take a couple. The first one is from Milind Orpe. He says that, look, he's found this series extremely interesting, and he wants to know how carve-outs are to be made in earnout structuring on account of sellers failing to perform on account of material adverse change resulting in MAE. So can earnouts be issued even when there is a MAE and there is a failure to perform? So how has that worked? I wonder, Vivek, if you've dealt with such situations, earnouts and MAE, and whether you can throw some light to the audience.
Yeah, I mean, I think firstly, I can respond to that from a buyer's perspective, and I think it goes back to the reason you're putting an earnout is to take uncertainty out from a buyer's perspective. So whether it is an MAE or just normal underperformance, the business hasn't delivered what it should have delivered. Yeah. So from a buyer's perspective, clearly they've benefited from having an earnout in place. I think the usual mitigation from a seller's perspective, what I have seen is people try and renegotiate the duration terms, and if it's a temporary event, people look at extending the duration of the earnout and say we're willing to, it's a one-off event, and hence give the sellers an opportunity to make the earnout by extending the earnout period or putting an alternate mechanism in place if parties can agree.
I mean, let me try to take a crack at it, which is,
yes.
I think in most deals you typically have between signing and closing a MAE clause where if there's a material adverse event, typically a buyer would not close the deal. But I think the question has been asked in the case of a event that takes place post-closing. In my mind, the way I think about it, again, just first principles, is post-closure of the deal, technically the risk sharing should be equivalent for the buyer and the seller, because both are owners of the business. And that's why I'm typically in favor of earnout structures, which are not just fixed payment structures, but they actually link to the equity value. In which case, if there's a materially adverse event, the reality is the value of the seller or the earnout that the seller will realize will anyways get impacted, in which case the buyer has to make good on that. That would be my view. So yeah, that's how I think about it.
Thank you. Very useful indeed. So I know we have lots of audience questions. Let's move to one more. This is from Vijay Shyam Acharya from Quest Global. He's asking how well can we handle a situation where buyer has an indemnity claim which is sought to be offset against a future earnout payment. So maybe Sharad, you want to answer this?
Sure. So, I mean, I think ultimately it's a question of sort of negotiating this upfront itself. So buyers would obviously want to, from their perspective, have the ability to offset any payments owed to them against payments owed by them to sellers. Sellers would want more certainty in their payments, especially when it comes to earnouts. So it would be a situation where sellers would normally make the argument that, look, you have sole recourse under an indemnity construct or under your W&I insurance for breach of your reps and warranties and whatever else that you want to cover for breaches. So any indemnity should not be offset at all. Now, I think from a buyer's perspective, I think this is just a fundamental point that you would want to kind of push through upfront itself across the document, where you're talking about a situation where you have the ability to offset payments owed to you against payments that are to be made by you. So I don't think that there is sort of a hard and fast rule as to how you can sort of enforce this effectively. It is all about whether or not you've covered it and had this discussion upfront in the sort of agreement itself.
If I may just quickly add a 30-second interjection there, because I just had this experience in one recent transaction. And ultimately, see, sellers will have to cave in if the buyer is a behemoth or, very strong party. You will have to, because you cannot logically argue against the fact that if on one hand there's an indemnity claim staring at you and you're still expecting that party to pay you some amount under some other arrangement. What you must have, though, while it's up to the commercial negotiation, if the seller has to concede, you must have some belts and whistles. For example, the claim cannot be a frivolous claim. It must be a claim which is substantiated by a legal opinion from a lawyer worth its salt. It should also not be tied up for any and all claims, but be linked to fundamental warranty-related claims. It should be for a fixed period, not that this whole earnout is languishing for 10 years, then the whole purpose gets defeated. And also, just to make sure that the buyer is serious in paying, make him deposit the money in an escrow during the litigation claim is pending and the interest is accrued. So once the amount is released, the seller is really earning at least money on that. It's not a lost cause. Some of these checks and balance must be put in place when you do end up conceding a set of provisions.
I mean, I'd just like to add a point, and maybe look, I do recognize both of them are value. But in my mind, indemnity is a value against representation or misrepresentation versus an earnout, which is value against performance. And so, I mean, that in my mind, they're actually different. But obviously, buyers can push through and railroad sellers into asking for these types of offsets. I think sellers need to be careful to be able to read the buyer's ability to bring across a claim that may be frivolous, and use that as a negotiating tool against an earnout. So keep it separate if you can.
I have been at the receiving end. I also dished it out, so I'm indifferent.
No, that's been very, very useful. I think a very short question we'll take. The last audience question. There are several. Some of them have already got answered. There were questions around COVID and how we've dealt with. I think we've dealt with already. But one general question, if anyone can share, any practical difficulty they faced in structuring earnout in the past and how they dealt with it, any practical experience.
I think
the audience.
I think this is good for Vivek.
Let me think of it. I think it wouldn't be a very specific one, but I think given that largely the panel is seems like a a sell side panel. One of the things which is a very practical scenario and goes back to the point around governance is the sellers, and for especially for companies like us, which are pretty active on the M&A front. For the sellers, typically, this is the end all, be all, and end all of their business. Maximizing the earnout. Whereas for somebody like the buyer, this is one of the multiple priorities for them in the business. And finding that balance and attention, I think, is very critical to every single transaction. And I think just from a practicality perspective, it just comes down, especially in the services business and the technology business, is all about growth rates right now. Where do you find the right balance between it being achievable and it being aggressive enough? Our learning has been businesses where we paid out earnout and or even paid out outperformance on earnout have actually done better for us. So it's never be a mechanism of saying that, hey, this is about saving a certain amount of money. But overall, any time we've or every time we've paid out a full earnout or actually an outperformance, the business has actually integrated better. We've done better. We've realized more synergy out of it.
One practical challenge, Haigreve, if I may interject, and to Vivek's wonderful point he just made, two lovely examples he gave, is the way typically Indian company operates, and it's kind of a substantial departure from how a foreigner will operate a company. And once they come into the shoes of that, and they still expect a complete transformational change, comply to their ABAC policies, comply to their standards, which are really lofty, heightened, far more stringent. And that gap to be bridged, and still the cost to be incurred and to meet the earnout targets, it can be a very practical, delicate balance to be navigated. And the best way to do is be transparent about it. Don't brush things inside the carpet. Take measures. If you're going international, tying up with a global player, you might as well up your game. And I think that's the way. Transparency, have a good demeanor about yourself when you conduct business, and I think things will pan out. It's often does when people are coy about it, they brush things under the carpet, that is where wrinkles start to creep in the relationship, and earnout or no earnout, it's not really boils well for a relationship between a buyer and the seller. That's the other challenge I see.
Well, thank you. Thank you very much. So I guess we are coming to the end of our webinar. And before we end, Prasenjit, can I ask you to give us 3 key takeaways from today's webinar that you think the audience should focus on while structuring earnouts and M&A transactions?
Thank you, Haigreve. I think some incredibly useful points have been made, very holistic points in this presentation. And if I have to summarize in 3 broad buckets, I would say the first one is have earnouts. This is the need of the hour in M&A deals. There is no way to stress test the valuation projections. A lot of this is future projections driven, and an earnout can be a difference between a deal being closed and a deal being aborted. So therefore, do resort to earnouts as a structural tool to hedge your risk, mitigate your risk, and reduce the logjam on valuation, and really incentivize the seller in the process as well. Point number 2 is, of course, the drafting bit. The contract should have a whole host of issues to be taken care of, right from what kind of rights the seller needs to operate between the signing and closing, and after closing, how will the closing impact the seller's right? Will it have any say whatsoever, or will it have no rights whatsoever? I think the answer lies somewhere in the between. A select list of reserve matter rights should be given to it. It should be allowed some degree of autonomy. At the same time, buyer should not outsource the running of the show to the seller after having paid a control premium, isn't it? So that's one set of rights. The second is how the earnout will be computed, the benchmark, the parameters, whether it's operational, whether it's financial, that doesn't matter. What really matters is those should be clearly defined, clearly arrived at. And the checks and balances should be in place so that one party doesn't indulge in opportunistic behavior or kind of a behavior which defeats the spirit of the earnout. Then once the earnout is determined, it should be computed in a manner which is fair. If I, as a buyer, kind of come up with a number, the seller should have a fair chance to review it through his accountant and really question it. And if it goes into dispute, to get an expert determination into the picture. The third is, of course, your other points regarding what happens if earnout is achieved and how long should the earnout be, so on and so forth. So those drafting related points are very critical, and what accounting standards will be applicable, which my friend Sumit touched upon. Lastly is the structuring. It's often the key. That's where the intellectual capital lies in the deal, isn't it? And there are accounting, tax, legal, a cocktail of these issues which are there. If you oftentimes jump up and down thinking, wow, it works from a legal standpoint, the tax guys will say it doesn't work from a tax standpoint. You then turn to Sumit, who will say it doesn't work from accounting standpoint. So then it's very important to not talk in silos, but get them into one room, get them to complement each other, and take care of the foreign exchange law, listed company, public company, accounting, IFRS, IAS. Is it upfront tax payable, or will you really seek a refund? Is refund possible? Are there evidences to demonstrate that you can get a refund? All of these structural issues are critical at the heart of earnout. If you don't do it properly, earnout will become a burnout. So don't do that. So on that note, I hope that this gives a good holistic recap of the points we have discussed. And all the very, this is last webinar of this series, which I have been a common thread of, so thoroughly enjoyed it. So slightly nostalgic. But over to you, Haigreve. I hope that gives a good recap.
That is fabulous, Prasenjit. A fabulous summary, very insightful, and very well put. So before closing, I'd like to ask each of our audience members to respond to the poll slide on your screen to provide your feedback on today's webinar. We take this very seriously as part of our continuous improvement program. And finally, I would like to thank each of our guests for sharing the experiences and expertise with us today. Vivek, Sudarshan, and Sumit, thank you so much. Without you, this webinar would not have been possible. You each did an outstanding job, and we are very much indebted to you. To our audience, I hope you found the webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you. After the webinar, we will send you a copy of today's presentation materials and the link to the webinar recording. You'll also separately receive a request for your feedback on the webinar. Please take time to send us your feedback, comments, criticism, and even compliments. The form takes less than a minute to complete. Please do not hesitate to contact us regarding any matters arising from the webinar. Our contact information is on the contact slide at the end of the webinar. Thank you for your attendance today, and we look forward to being of service again in future webinars. Thank you.
Thank you.
Thank you.
Thank you. Bye.